Hello, greetings, and welcome to Dividend Blasters. This is our 40th video, and the topic today, the Cagr, is everything. Yes, the compounded annual growth rate with respect to your dividend makes a huge difference. It's everything. It is the world. What I'm going to do is I'm going to build on our last video a little bit. I'm going to use Visa as an example. And as you know, Visa is a very good dividend growth stock that I discussed in the last video. I'm going to run a couple of scenarios where I'm going to show you the difference that one dividend growth rate makes over another. And I'm not going to use a huge difference between the two scenarios that I'm going to show you. I'm going to show you a modest difference. But over an extended period of time, the difference in the holdings is going to be massive. It's going to be huge. Remember the dividend snowball we've talked about? Well, that's what this speaks to. All right, let's press on. First and foremost, I am not your financial advisor. The purpose of this video is for financial education and information. Reflects my own personal opinions, research, and my experience as an investor for more than 30 years. So I urge you, do your own research, do your own due diligence before making any financial investment decisions. Consult a financial advisor. All right, let's press on. Before we do, I would kindly ask for you to give us a like on this video and subscribe to our channel, Dividend Blasters. It's very helpful to us. And if you find this video informative, educational, useful, share it with a friend or a family member. All right. So what I did here is I am a subscriber to MarketBeat, and they have a wonderful calculator that I like to take advantage of. Now, I've done calculators for years and spreadsheets like Excel, and I'm pretty good at it, but I am a fan of keeping it simple, keeping it easy. And if there is an app that I can leverage that'll do it faster, quicker, better than me, I'm all for it. MarketBeat is that app. So what they do is they have an app online at their site where you can type in the name of a stock, and it will automatically fill out whether it's a stock or it's an ETF, the distribution frequency of the dividend, if you're dripping or not, and I am a fan of dripping, the starting number of shares. As you can see right here, I am starting out here for our example, our scenario 1, 25 shares. This is the latest closing price of $223.57. And I'm going to presume that we are going to contribute $500 a month, $6,000 annually. Capital gains tax rate 15%. The dividend yield, as we know from our last video, is 0.81%. Now, here, this is where it's a little different, and it gave me the idea to go ahead and show you the impact that a different Cagr makes. MarketBeat has a default Cagr, or dividend growth rate, of 14.47%. Okay, so we're going to go with that. I'm going to use that. That's a little different than what I got out of Seeking Alpha, which was 17.2%. That was the 5-year Cagr. And that's the one I like to use. I think it's reliable. But here, let's use 14.47% for instructive purposes. And we're also going to assume an annual price appreciation of 3%. I think that's very reasonable. We're going to do it over a period of 30 years. We're going to do two scenarios. So this first scenario is a Cagr of 14.47%. Then we're going to look at a Cagr, a dividend Cagr of 17.2%. All right, let's take a look and see how it turns out. So for 14.47%, we see that the portfolio balance after 30 years will end up at around $914,000. That's 30 years. Look at the progression. At 10 years, it's $81,704. At 20 years, it's $234,406. Then it begins to increase after 20 years, a little bit more. So that's the dividend snowball at work. It's growing. You're dripping 100% of your dividends. You're also continually investing your $500 a month. At 30 years, you have a respectable $914,274. That is not bad. Not bad at all. Let's take a look at what your dividend income is. Well, after 10 years, you're going to get an annual dividend income dripping 100% back into your holdings. At 10 years, $1,513. At 20 years, wow, it's going to go up to $12,710. At 30 years, when you get to your $914,000 balance, you're going to be dripping at that 30 years, $132,449. And then hopefully you're going to gain the benefit of the fruits of your investments and start to draw down and enjoy your retirement. Then let's look at the yield on cost. And remember, yield on cost is your dividend income divided by your investment in your holdings. After 10 years, your yield on cost is 2.56%. After 20 years, because of your growing dividend income, which is dripping, you're going to be at 10.87%. So it's going to go up by almost 5 times. Then at 30 years, wow, it's going to go up almost 7 times from 20 years to 78.68%. So think about that. At 30 years, you're going to have $914,000 portfolio balance and annual dividend income at 30 years, $132,000. That's pretty good. Remember, your dividend compounded annual growth rate is 14.47%. All right. Now let's look at scenario 2, where we have a slightly, ever so slightly higher Cagr. It's about 1.6, 1.7% more. So the Cagr here is 17.2%. Everything else is the same. We're dripping. We have the same number of shares we're starting with, and I need to be clear about that. We're starting with this with 25 shares, so it's a little over $5,000 with a share price of the same 223.56, 8 years 0. We're going to contribute $500 a month or $6,000 per year. There's an annual tax rate on capital gains or on your dividends annually 15%, qualified dividends. Remember, your dividend yield is 0.81 at the beginning before any of the dividend growth starts. But remember, each and every year, we're going to presume a dividend growth rate. And in scenario 1, we presumed 14.47%. This is based on historical fact. Okay. But the 5-year Cagr here we're using in scenario 2 is a little bit higher. It's 17.2%. Okay. Historical fact. We're going to presume the same price appreciation of 3%, and we're going to look at where we are after 30 years. Let's take a look. Aha. So remember, $914,000 in scenario 1. Here in scenario 2, with a very slightly increased Cagr, we're more than double, 2.125 million. Instead of the 133,000 in dividend income in year 30, we have 533,000 in dividend income. And then instead of the 76% in yield on cost in scenario 1, we have 338%. What does that show you? That shows you a marked difference in your portfolio balance after 30 years, and in your dividend income, and in your yield on cost. Look at what it is at 20 years. At 20 years, here in scenario 2, you are doing phenomenally, but it's respectable. But what you see here is $267,000. It's going to go up by almost 10 times between year 20 and year 30. And then your dividend income is going to go from 22,000 to 533,000 between year 20 and year 30. You see, it goes very parabolic after year 20. It's very flat for many years. It's really flat for about 15, 16, 17 years. Then it starts to go up. Then after year 20, when you start to get into year 23 and 24, it really starts to take off. Look at that yield on cost from year 20 to year 30. It goes from 19% to 338%. It's a thing of beauty. let's take a look at them side by side so it becomes really clear. Scenario one, 914,000. I'm looking at ending balance. Scenario two, ending balance 2.1 million. Look at the average annual return. Okay, the average annual return is 5.46% versus 8.47%. So that's scenario one versus two. Look at that annual dividend income. That's after 30 years. So it's really 30 years plus one. Now you're at 188. Okay, after 30 years for scenario one. At scenario two, you're over 958,000. You're approaching a million a year just with your dividend income. Look at that. Look at the look at those dividend payments over time. And then again, the yield on cost, the 78.7% versus the 338%. Now let's take a look at, and this is a little bit of an eye strain, and you may need to go ahead and expand this, but it's everything I just said. It shows you the progression of your annual dividend, and you can see the difference. Okay, in the fourth column, the annual dividend um, between scenario one and two. You don't look at the annual dividend per share. The annual dividend per share in year 30 for scenario one is $91. For scenario two in year 30, it's over 180. And look at the number of shares. The number of shares is 14. Second column, 1,450 in scenario one, and scenario two, it's 2,955. Now, I'm going to be very candid. They're not working in stock splits, and you can be reasonably certain that there will be stock splits because the price will be so high that they will want to make the price attractive for investors. So they're going to split it. It'll probably split 10 times. So instead of having 2,900 shares in scenario two, probably have 29,000 shares. So this is dividend growth investing at its absolute finest. I already talked about the new balance, the 2.1 million versus the 914,000. You see those in the last columns. So what I'm trying to do is I'm really trying to drive the point home that this works. The lesson here is to stick with it and to be steady, because stock investors, dividend and growth investors, it's a battle. It's a zero sum game between those who are patient and stay the course versus those who are not and overtrade. You pick a good investment, a steady investment, and you stick with it and you continue to invest, you continue to drip, you will see the fruits of your labor. And that is all I have. This is a shorter video, and I do hope that you found this to be informative and educational, and you found it a little entertaining. Please give us a like and subscribe to our channel, Dividend Blasters, and share it with a friend or a family member. Until our next video, have a wonderful day and God bless.